Welcome to Fintech Daydreaming, the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies. We bring you real-life examples from global and local thought leaders, as well as experts working within the financial industry, and seek out the best stories from the front lines of financial services innovation, where dreams of industry pioneers meet reality. Hosted by Paul Krogdahl and Ville Sointu. This is Fintech Daydreaming.
Hello and welcome back to Fintech Daydreaming. We are indeed back. It's been a long and hot summer. Still some of the hotness left here in Finland at least, but not hot enough for us not to start the new season. My name is Ville Sointu. I will be your host for today's episode of Fintech Daydreaming, but of course I'm joined as always by my good friend and co-host Paul. So Paul, how was your summer?
My summer was fantastic. We spent an extended period of time down in Italy with my girlfriend and her family. So I got to see the family side of Italy, which was fantastic for me. The only time since or before this that I've been in Italy has always been for business. You know, you fly in, you see the airport, hotel, customer, hotel, airport. This time I got to spend a good amount of time just enjoying Italian life, and it was fantastically wonderful. I did not want to come home, so maybe future apartment somewhere in Italy is on the cards. Let's see. Apart from that, for the summer, as you know, Ville, and for the astute listeners that are following us on YouTube, they might notice that I've got a different background now, and that's because we have moved. We had a very big house in Espoo, and we have relocated ourselves, which also happened during the summer. So I'm surrounded by moving boxes. I've moved them out of the way so that they don't show up here. And maybe I'll figure out how to get our fantastic Fintech Daydreaming sign to show up properly behind me. But at the moment, it's obscured by my big head. But we'll see what happens going forwards. But I am fantastically excited to be back doing season 12 and getting back into the joyfulness of fintech and banking technology.
Indeed. I mean, you had a really, really busy summer. I mean, you moved, you went to Italy, and you indeed sent a lot of videos and pictures to me about all the food and wine you had. So a little bit jealous, can't say that I'm not. So it's looked like a lot of fun time. And I'm still waiting for that cart of or box of Italian red wine that you promised me. But so let's see if you deliver it anytime soon.
I promised that we would share some wine. So absolutely, you're going to get it, but I'm not going to give you a box of wine. I'm going to let you enjoy it in my company here in my new apartment when you cook that fantastic food that you always cook for us.
Okay. I think I'm going to need to find the recording of you promising that. So we're going to go to court about this. But okay, let's not do that. However, let's start with the season, because again, enough chit chat. We didn't talk about the weather, so we're going to skip that part at least. So we're going to move on and get our guest also into the conversation. And I couldn't be happier for our guest today in the episode. This is a person that I met a long time ago. And when we started the podcast, I always thought that I really want to have him on the podcast because he was always been somebody I've looked up to in the world of fintech and banking for a long time. So without further ado, Tony, welcome to the podcast.
It's a pleasure to be here, guys. Happy to join you. And I love Finland. What can I say?
Yeah, good. Actually, last time we met, Tony, it was actually in Finland. I think you were speaking at the Mobi Forum, I believe.
That was quite some time ago. Yes, absolutely.
Yeah. It was in the middle of the pandemic. They literally kind of opened up the world for like a minute, and then we had the conference, and then it closed up again. But did have a chance to meet you then.
Yeah.
But Tony, I mean, let's get the audience also acquainted with you and your work. So maybe a bit of an introduction. So who are you? Where are you coming from? And what took you to the place you are today?
Sure. I'm Tony. I'm from Scotland. I'm very kind of like tall Scottish guy. So I don't know, maybe there's some kind of Viking influence genetically back in the day. Otherwise, why would I be so tall? And I've been working in payments for big banks for 30 years. And for a long time, I've been thinking about what is money and what are payments, and is the way that we do it today the best way of running the railroad? So I consider myself a little bit of a payments nerd. I'm sure you guys do as well. And I've come to some conclusions about the future of payments, and I'll be happy to share my crazy ideas.
Indeed, indeed, and we're going to get all the way into those conversations, and we're going to see where we land. But before we kind of go down the deep end, we do have to get a little bit of tradition out of the way we have in the podcast. So everybody listening already knows what's coming up. Tony, you might also have heard about this, but we do require at least one fintech related bad joke, preferably in every episode of the podcast. And this time around, I believe, Paul, the honor is yours to punish us with your humor.
The honor is mine, is it? Okay. Well, I'm also noticing that unfortunately there is something wrong with the recording that we've got set up here. I'm not showing up when I speak on my video, so I am not too sure. I think I need to. Can you guys see me?
Yeah.
Yes.
Yeah, you can. Okay, but worst case here, I will not be visible, and you will be seeing Ville and Tony for this whole episode, and not me, which is probably good in one way or another. I don't know, but that wasn't the joke. That's just our technology problems not working. And as we never edit and we go for this, let's hope that you can actually see me. But for a joke, yes, I found a bad one, Ville. I did some digging, and it goes, why does Superman shift his stable coins to fiat every night?
I think we did a joke related to Fiats and Ferraris related to stablecoins earlier, but I don't think this one's it. So tell us.
He wants to stay away from crypto night.
Hey, I actually like that.
But there you go. It was a good but bad one, and I have to thank ChatGPT and the internet for digging that one out for me.
All right. Excellent. And that actually leads quite nicely to the topic that I believe we'll be discussing a lot with Tony today, which is, of course, stablecoins. But let's not get ahead of ourselves before we go to this deep dive on the stablecoin part, because we, of course, want to hear from Tony as well. I mean, I know you from your background from Citibank, from regulated liability network work that you've done in the past, but now you've started on your new journey, I believe, with a company called Ubyx, if I pronounced that correctly. And maybe we'll start from there. So again, what is Ubyx, and how did you end up going there? I mean, you had a very successful career in a large global bank, and you decided to do something completely different. So why did you end up there? But let's start from the what is Ubyx and what you do.
Yeah, so Ubyx is a stablecoin clearing system. And why do we need a stablecoin clearing system? Because there are going to be lots of different issuers of stablecoins, and they will be accepted in lots of different places. And that creates a many-to-many network. And in payments, at any time that you have a many-to-many network, you have a clearinghouse. So that's what Ubyx is. And I'm happy to elaborate on that or go on to your other part of your question.
So just to help some of our listeners, because we're all geeks here and we understand, but I can imagine some of my listeners or some of our listeners now saying, but isn't that just the same as a crypto exchange?
So that's a good question. So a crypto exchange is an order book where things are bought and sold. And a clearinghouse, it's also interesting because when you say the word clearinghouse to a markets person, they think about a central counterparty. But when you say clearinghouse to a payments person, the clearinghouses are a little bit more simple. And really what the clearinghouses are in the payment space is just a way for the parties to settle their obligations, but not through buying and selling. So an ACH, an automated clearinghouse in payments, isn't buying and selling the obligations of the participating banks. It's essentially routing the transactions between the banks and affecting their settlement. So there is a very important distinction between, well, three things that we've mentioned. Number one, a clearinghouse in the payment space is not a central counterparty. Clearinghouse in the market space is very often a central counterparty, security space. And an exchange is a venue where buying and selling takes place. So those are three different things.
Okay, I think that's good clarification to the topic, because we are really in the area of stable coins and almost like digital currencies in a way as well. So it's going to be good to clarify these things as we go along. But to the other side of the question that I had. So again, personally, how did you decide to go to Ubyx?
Yeah, so it's basically it's the US election result. I'm afraid that if the US election result had gone the other direction, I would not have left my previous employer. Still be there. But the significance of the US election was, for me, very specific. And it was the realization the day after the election that banks in the future would be able to use public permissionless networks. And that was not the case the day before the US election. So once I realized that banks would have a way to get onto public blockchains, my thesis had to change. You know, the projects that you mentioned before, like regulated liability network, I thought that the design space was limited to private permission chains. And you run into, well, there are several conclusions there. You run into the conclusion that the technology and private permission it's fine. There's nothing wrong with the technology, but what you have is an adoption problem. In the public space, you don't have the adoption problem because the networks already exist and they're being used. You just have to join them. So the implications of the US election, a lot of what's happening now, I tell you honestly, it was visible to me the day after the US election. And I decided that I had a contribution to make to a good market structure, because the stablecoin market structure today is not good.
But isn't this predominantly very US-centric then, rather than global?
It's coming to a bank and a fintech and a country near you very, very soon. And in the same way that what's really happening is a format change. You know, we're all old enough that at one point we were listening to vinyl, and then you were sticking pens through mag tape and winding them up to get them to be tight. And then you were doing CD, and then you were doing mini disc, and now all of that is gone, and you're doing streaming with Spotify. That's what's happening now. And you're going to shortly be using stablecoins for every type of payment.
All right. Just one note on your personal journey. I mean, I always remember when I met you for the first time, Tony. I'm sure you don't remember, but I think it was in 2018 or maybe 19 in Amsterdam. I was attending the Money 2020. There was like a street party was there, and I met Dave Birch, who I knew from before. And then Dave decided, once I told that back in the days I was responsible for DLT and blockchain for the bank that I was working for, still I'm working for. And then Dave said, "Hey, you need to talk to this one guy." And then you were there, and Dave introduced us. And then once you heard that I worked with blockchain, your first comment was that, "Well, blockchain is just nonsense, isn't it?" And then we ended up having a good conversation where we actually agreed on a lot of the things that blockchains are and what they are not. But sounds like this was like more than 5 years ago, 6 years ago. So your thinking on blockchains has evolved, or has it?
It has evolved significantly because at first sight, to be honest with you, I thought that blockchain to me looked like a crappy database. And indeed, probably a private permissioned chain within a single bank is a crappy database. But then I decided to take the thesis seriously and try to figure out what is that special sauce? What is the thing that people are grasping at? You know, there are lots of buzzwords about blockchain, but what is the thing that people are grasping at when they want to apply blockchain to regulated financial services? Because that's not obvious. Blockchain was not invented to make banks work better. It was invented as the antithesis of intermediaries and the antithesis of issuers. So absolutely not clear why a technology that wants to do away with banks is good for banks and fintechs. But I got to the point where I began to understand blockchain as a who owns what machine, as a good who owns what machine, as a state machine. And then I got to the point where if I look at the financial system from above and I see it largely being orchestrated through messaging, I then began to understand that if you had a state machine which helped update the balance sheets of the participating banks, there would be value to that. But the route to get there can't be a private permissioned ledger because you can't get everyone to agree on using the same private permissioned ledger.
So then I've got a related question to this, because we are talking about stable coins. That's the premise here. You're talking about the intermediary for stable coins. Are we saying then that there is a correlation here that says stable coins can only exist with a blockchain?
Well, the thing that a stable coin is just a digital representation of something else. What's interesting about blockchains as a representation technology is that they are general purpose. So there is a token on a public chain, and you can make that token mean anything you want it to mean. So that's general purpose technology. Now, in your faster payments system in Finland, you can only make the transactions mean low value payments in local currency. That's special purpose technology. So in the history of technology, when you give the general purpose technology a chance, it tends to subsume the special purpose technology. And that's, I think, what's interesting about what's going on. It's about the form factor being more general purpose, and it will have staggering implications on banks. And some of these are not obvious, but they're evident once they're explained.
I'm very tempted to go down the rabbit hole of legal certainty and the legality of these things, but let me double click on one specific point you made, which is that stablecoins is a general purpose technology. Now, we know the limitations of existing public blockchains, the fact that there is no real legal finality in its current form. There is severe lack in issuers. There's very few ways for people who are not really into the scene to actually validate which kind of coin is trustworthy and so forth. And furthermore, I mean, what it sounds to me like there's a bit of an obfuscation between the technology and the legal frameworks and the regulation here happening, because you could also argue that every single digital service, including the traditional payment services, are built on general purpose technology. I mean, database is a general purpose technology, web servers are general purpose technology, and so forth. But let's focus on the kind of functional and legal regulatory framework here for a bit. So let's start with the legality of these currencies. I mean, the challenge is that there's a huge fragmentation when it comes to stablecoin regulation. There's a lot of obscurity when it comes to these issuers. How can the banks actually potentially turn around and start using stablecoin rails with these limitations in place?
I think the trick of it is not to be confused between code and law, or let's say it a different way. The underlying instruments that we've been transacting in for hundreds of years are not different. So let me try to prove that to you. If you give me 100 euros and I give you a piece of paper, and on that piece of paper I write, I owe the bearer of this piece of paper 100 euros payable on demand. You would agree that that's a promise to pay. I hope you would also agree it's a negotiable instrument. That piece of paper can either be presented back to me or it can be sold to someone else. That makes it a negotiable instrument. So here's the question. Is the intrinsic nature of that instrument the piece of paper?
No, it's the trust, basically.
Well, it's not the piece of paper because it could be on a clay tablet, it could be etched into steel, or it could be represented as a token on a blockchain. And so really all we're doing is we have the same legal instrument represented with different technologies, and the representation technology is not intrinsic to the instrument. So this is, one of my current bugbears is when I see regulations written that say stablecoins are crypto assets with reference to fiat currency, I find that preposterous, because that would be like defining a check as a piece of paper with reference to fiat currency. The technology we use to represent legal instruments is entirely irrelevant to their nature. So all we have to say is this. I mean, I say it, all we have to say, but I think the better approach is to say, look, if we want to have negotiable instruments on paper or metal or clay or blockchains, they're all the same. The rules are all the same.
But I'd like to follow on to what Ville just said there about trust. I mean, all of this actually does come down to trust, irrespectively of whether you represent it on seashells or pieces of paper or anything else.
Yeah.
One of the key issues here is the fact that you need to ensure that there is trust at the start of this. Like you said, if we give you 100 euros and you give us a piece of paper that says that you will pay back the 100 euros, there's a fundamental element of trust there. There's a trust that says you will pay it back, and I believe in that. And that's driven by the regulations. It's driven by trust in the central bank, and so on and so forth. You take those elements away, you get anarchy.
Well, you don't take those elements away. Those elements have to be baked in from the beginning. And that trust is deep into the social contract. So the social contract, Paul, is you give certain monopolies to the state. The monopoly over making law, the monopoly over force. They've got the police, they've got the military, you don't. And the monopoly over money. And when a new form factor comes up, the nation state will say, that's nice. Now you've got a negotiable instrument on a new technology. The laws are the same. We've got negotiable instruments denominated in national currency We know how they work on paper. We know how they work on clay tablets. We know how they work on blockchains. The mistake that we're all making is to imagine that these things are novel. They're not. The novel thing is the representation technology, and I think we decided that the representation technology is arbitrary. So next year, if someone creates next year a way of representing promises to pay with holograms, it's the same legal instrument.
There's one small variation here, though, and maybe we're going into rabbit holes like Ville tried to prevent us from doing. There's a fundamental discussion between private and public money, right? Fiat currency is public money. It's issued by the central bank. Stable coins are, for all intents and purposes, backed by the public money. But the minute you convert then to the stable coin, you're actually converting to private money, which means that you've got private entities behind that, whether you have given them the fiat currency or not. No different than a bank. You deposit your fiat currency into a bank and it automatically gets converted into private money. So again, there's a trust element. We trust our banks when we give money to the banks. If the issuer of the stable coin cannot be trusted or is not a legal entity that's regulated and managed in the same way as a bank, again, you end up with issues, right?
Well, there's what's the tree? There's in sovereign currency, there's the public side and the private side, and all of the private issuers are regulated. They can be banks and they can be non-banks. So you've got central bank issue, non-bank issue, all of sovereign currency. Stable coins that are denominated, which are denominated by definition in fiat currency, should be regulated. You know, I'm a sovereign currency guy. I don't tolerate non-sovereign issuers. When I say non-sovereign issuers, I mean everyone needs a license from the nation state. You know, so I'm agreeing with you.
Right.
But the one thing about money today, especially within a single currency, is that it's entirely fungible. So no matter which ATM you go to in the Eurozone, you will always get euros. And those are, of course, you can deposit and use them as you will. With stablecoins, when every issuer has its own stablecoin with the, let's say, still regulated license to do that, backed by proper fiat currency or other instruments of value, and that's all fine. But they are still the coins or money of that specific issuer alone. So it's not automatically that you can then just use it anywhere or exchange it automatically. It resembles to me the era of this of free banking in a way. Earlier, when individual banks used to print their own cash, and that ended up in a disaster. Ended up in basically a central bank system that we have today, for more or less. So how do you see? I mean, I'm sure this is a nice opening for Ubyx now, but I mean, how do you see this fragmentation issue?
It's not unusual for there to be many issuers. And if you think about, again, in the world of checks, everyone can issue. Now, back in my earlier years, when travelers' checks were predominant, travelers' checks were accepted everywhere in Finland. Travelers' checks were accepted everywhere around the world. Many issuers, many people to accept. In the age of cards, there are 16,000 issuers of cards around the world. When someone you can have any one of those 16,000 cards and walk into a department shop store in Helsinki and use it, and then you get a very important property, which is the department store is indifferent towards the issuer, absolutely indifferent towards the issuer. So in checks, in cards, you have a clearing system, you have a scheme essentially. And that scheme brings about an extremely important feature, which is indifference towards the issuer. So the market structure, believe it or not, Ville, is going to be that you're going to be able to accept stable coins from many issuers and not give a damn about the issuer. That's the market structure which is going to come. And the way that you will do that is you will deposit those stable coins into your bank account or your fintech account. And the reason, Ville, why your bank, I mean, you may not have this in your plans or your budget or not, but your bank is going to open up to accept stable coins. And the reason for that is because every foreign stable coin accepted by your bank and converted to local currency is FX. And your bank loves FX. That is why your bank is going to enable you to accept stable coins. Whether you know it or not, that is going to happen.
Yeah, I'm really looking forward to that future happening. Let's see what happens. But on that note, I think this leads nicely into the fundamental question that a lot of people have when they hear all about new technologies and all the hype. So obviously we're talking about stable coins being in the headlines now all the time. But I think the question in the back of everybody's head is that what are they actually for? So what are the actual practical use cases that this will enable for businesses, for individuals? What's going to happen? I mean, even if it's just something will be faster, better, cheaper, and therefore same use cases, but still, I mean, where do the stable coins have the most impact, and how will it be visible to everyday users and businesses?
Yes, look, the use case question, I can give you very, very large use cases that will come, and I'll do that if you wish. But given it's a Finnish audience, I hesitate to use the analogy of the Russian doll. But if you'll forgive me, the real reason why stablecoins will dominate every use case is because it's the biggest Russian doll. And the form factor of a token on a public blockchain can exhibit the features of all previous payment types. So at the moment you see kind of cash-like nature of stablecoins. And soon you will see check-like nature, and you will see wire transfer-like nature, and you will see faster payments nature, and you will see card nature. All of these things can be embodied in this form factor, and that makes it the biggest Russian doll. And that's the reason why the phone has taken over from the alarm clock and the calculator and the CD player, because it encapsulates the previous form factors. Stablecoins, their killer attribute is that they're the biggest Russian doll. Now, if you want a specific use case, do you guys have e-commerce in Finland?
Obviously, yes.
Lovely. What proportion of the stuff that you buy on your favorite e-commerce website is made outside of Finland?
95% plus.
Okay, so what will happen is I don't know who's the dominant e-commerce player in Finland, but they're going to realize this is happening. They're going to realize that it's preferable for them, it's advantageous for them to pay the overseas supplier in their own stablecoin.
But why? Because especially within Europe, I mean, we obviously have instant rails already in place. It's not about the speed. I would argue it's also maybe not about the price. So what does stablecoin actually bring to that picture?
Well, are the things that you buy on your e-commerce websites made in Europe? I don't think so. I think they're made in Asia Pacific and maybe the global south. And so the suppliers in those countries want hard currency in portable format. So the people in those countries will be very happy to receive a stable coin in hard currency. And the benefit for the marketplace is if those suppliers hold on to the marketplace's stablecoin, then the marketplace makes the money from the yield on the stablecoin. So that's I don't know the value of e-commerce sales in Finland, but I'm sure that 70% of that is made in countries where there's a demand for hard currency, and the dominant marketplace in your country will figure that out, and either they'll do their own stablecoin or they'll do a co-branded stablecoin with someone else, and they will pay the foreign suppliers in that stablecoin.
But then I can play the idiot in the room again, because sometimes I like asking the questions that our listeners are too scared to ask, right? A stablecoin by its very nature is pegged to a fiat currency.
Yes.
Right? So you're saying it's a US dollar stablecoin or it's a euro stablecoin. You're already talking about not just cross-border, but cross-currency at this very moment in time. So if you say, I'm sitting in Finland, everything we do is in euros, and we've got Asia Pacific, yen as a good example, am I then paying stable coins in the value of euro, or am I paying stable coins in the value of yen? Which means that you get straight back to FX, which means I might as well just pay in euros and the FX happens.
Well, again, imagine that you are a supplier into a Finnish marketplace and you're sitting in Vietnam and you receive a euro stablecoin. That's interesting. Because the opportunities for that supplier in Vietnam to have a euro bank account are probably quite limited. So you receive the payment for all of the, let's say, the plastic toys that you've sent to Finland that Finnish people have bought on the marketplace. And you receive a euro stablecoin and you say, okay, that's interesting. Now I have a euro balance. Well, maybe I've got some payments to make in euros. Or maybe I just want to have some euro hard currency. So here's what I'm going to do. I'm going to convert half of those stable coins into Vietnamese dong, and I'm going to keep the other half. So to the extent that this supplier in Vietnam wants to have euro exposure, the marketplace who has sent the stablecoin, issued the stablecoin, is making the yield on that money.
Yeah, I understand your arguments. I'm taking a very simplistic view here. I could say Revolut already gives me that capability, and having multi-currency accounts that are not stable coins, they're actual, fiat accounts. So I could have a Revolut
in Vietnam.
Oh no, so that is a different point. Is Revolut currently available in Vietnam or not? No, but the argument here is the capabilities that you are promoting can also be provided by existing rails.
Well, again, we're talking about someone sitting in Vietnam and Thailand who's doing business with the Finnish marketplace, and very shortly we'll have the opportunity to receive stablecoins into a wallet. And this is one of the things that I wanted to touch on, which is very, very important to understand, is that the wallet is much more general purpose than the account. So Ville, you give your clients some lovely accounts, and all they can keep in those lovely accounts is a bank balance. Well, there's a bank balance is good. There's the bank balance which includes an available balance. So maybe you give them also a line of credit, which is very nice. But a wallet is much more general purpose, because if I have a wallet, then I can have stable coins from many issuers, tokenized deposits from many issuers, tokenized treasuries from different asset managers, tokenized money market funds, all in the same wallet. So again, believe this or not, the future battle is for not who provides the account, it's who provides the wallet. Who provides the wallet? And the wallet is to, in this space, the wallet is to the account what Spotify is to the CD. Your account is a one-trick pony. And if banks don't wake up to this, they're going to be in significant trouble So my firm recommendation to every bank is you need to offer your customer a wallet. You need to. It's no big deal. You give them an account and you give them a wallet. The battle is for who controls the wallet.
I don't know if Ville has gone very quiet on purpose. I can't actually hear him.
Me neither.
No, Ville, we seem to have lost your audio.
Okay, now you can hear me, right?
Now we can hear you again. Yes.
I was not on purpose. You can actually saw me talking, so it was just a technical glitch. So this leads actually us into one of my favorite topics surrounding digital currencies and stable coins, specifically on public blockchains, which is the fact that, I mean, Tony, obviously you talk to a lot of banks clearly in your current role. So you hear these arguments on why these stable coins are problematic, given the current landscape of regulation around the world. And the usual questions are related to things like, well, if we are doing cross-border payments to Vietnam, and today it takes a long time, it's expensive, but many banks would argue that it's like that for a reason, because there's a lot of things related to sanction screening, KYC, AML, counter-terrorist financing, all of these controls that need to be in place in order for that transaction to happen. So the usual thing that we discuss is that this is actually not a technical problem. Anybody could set up a database and say that this is a ledger that you can trust around the world. We place it in Bermuda or some other loose place for regulatory supervision, and off you go. So how do you see, I mean, how do you answer the banks that have these questions? So how do they keep on being compliant with the regulations that they are under with this new world of stablecoins?
Well, Ville, there's two things to say. Number one is that again, as I said before, the law is underlying. So apply the existing laws, impose the same requirements as we have in the fiat world. Although I would argue that a stablecoin is just a new form factor of fiat currency. It's not outside of the fiat currency system. We have to bring it in to the fiat currency system. But the other thing I would push back on before answering that question to any banker who asked me would be, have you ever seen a stablecoin? And most have not. Most have never seen the instrument of which they speak. I see, recent pronouncements by senior people in banks, leaders of banks, talking about stablecoins. I know they've never seen a stablecoin. So let us drop the fear. Get a wallet, Phantom Wallet, MetaMask. Get some stablecoins. Conduct stablecoin transactions amongst your team, and you will soon see all of the frictions. And you know what the really interesting thing is? A lot of the frictions and a lot of the downsides of stablecoins are solved by bank and fintech participation. So, Ville, so let's say the American stablecoins, those brutal Americans, how dare they, with their stablecoins, impose themselves on Finland? So the stablecoins are coming from those uncouth Americans into Finland. Where in the national interest of Finland, should they arrive in an unhosted wallet, or should they arrive in a wallet offered by your bank? They should arrive in a wallet offered by your bank. So your participation, on public blockchain networks, people say, well, I couldn't possibly be on a public blockchain because the validators are in North Korea. Well, become a validator, and then you increase the chances that the validator is a regulated institution. So there's the banks are standing at the threshold of you're in Finland. Nokia is the prime example. When I had my Nokia, I could not imagine anything more simple, anything better. I couldn't imagine what was coming next. Then when I had my BlackBerry, I mean, my God, the Nokia example, and then it moved to research in motion for my Canadian friends. I couldn't imagine anything better than my BlackBerry. It was inconceivable that anything would replace my BlackBerry. And then it did. So banks are facing a Nokia BlackBerry moment. And, we can revisit this, Ville, in another 5 years, see whether any of these predictions come true or not. But that's my bet. My bet is that they will come true.
So in the interest of time, I see that we're rapidly running out of time here. I've got another question that I'm sure our listeners are sitting there pondering on. We've had lots of discussions ongoing about stable coins globally, and we've heard the president in the US promoting the idea of stable coins. Here in Europe, we're talking about central bank digital currencies. So for our listeners, maybe we want to just level out the playing field a little bit to explain the difference between the stable coins and central bank digital currencies, because to the layman person on the street, they sound very similar. They seem to be the same instrument. So what's the difference here? From your view, do you see stable coins, CBDCs, is same but different, or is it very different?
So you have a token or something that represents a euro, and that token can be issued by a central bank, that's a CBDC, or it can be issued by a commercial bank, that's a tokenized deposit, or it can be issued by a non-bank, and that's a stablecoin. So it's a promise. This token means I promise to pay you €1 on demand. Now, the maker of that promise can be a central bank, a commercial bank, or a non-bank. That's the difference. The difference between those instruments is the maker of the promise.
Even though, of course, the ECB, for example, with the digital euro is not going down that route, as we've been discussing previously in the podcast many times. They are indeed going for the account-based setup, but that's a story for another podcast. I have a feeling that almost like every sentence you said, Tony, was going to lead down to a rabbit hole, and that could have taken an hour to kind of go a little bit back and forth on everything. But it's fair to say that we don't want to torture our listeners with a 6-hour episode. So we're gonna have to leave it there in interest of time. Again, it's been a lovely discussion. But before we go, was there anything that you wanted to talk about, Tony, today that we didn't get to talk about yet?
Well, I think the key thing in this transition is to understand the stablecoin game. The stablecoin game is a very interesting one. You wouldn't play Monopoly without reading the rules first. And lots of banks and governments are rushing in to try to figure out how to play the game without reading the rules first. So number one is to understand the nature of these instruments as negotiable instruments. Number two is to look at the economic drivers. Every stablecoin that our American friends send to Europe is a gift. If we catch it in the regulated financial system and convert it to euros, it's a gift. Every stablecoin or every tokenized deposit that we send in euros outside of Europe is a gift to those countries, because the bank in Vietnam who is providing the wallet to the supplier of the Finnish marketplace can do FX on that euro stablecoin. It's a gift. So if you approach the stablecoin game understanding it, the strategies for nation states and for individual banks is different from what people think it is. And on the bank side, lots of people are rushing too quickly towards thinking about issuing. The first obvious thing to do is you receive, because your bank loves FX. believe me, your bank loves FX. And every foreign stablecoin received into your bank makes FX. And the reason why this is so virtuous is because it will be the catalyst for you to provide your clients with a wallet. And if you don't provide your clients with a wallet, you're going to be dead in the water.
That's a powerful statement to end with, and I really believe, Tony, we need to have you back on the podcast in maybe a year to discuss the where did we land with all these predictions, and hopefully hope to get you back soon. The final question I have for you, Tony, of course, is that so what's next? Is there something? Are you working on something specific that we can look forward to, or is there other work that you would like to promote at this time?
We're going live with our clearing system. We have a community of, the mission of my company is stablecoin ubiquity, which is stablecoins for every payment type. Every bank and fintech needs to be able to receive and process stablecoins. So to the extent that you want to go on that journey, please reach out. I'm on LinkedIn a little bit, so you can find me on LinkedIn and website. But delighted to speak to people. If you're confused about your stablecoin strategy, we have some clues.
So there you have it. So, and you already covered the where can people reach out to you a bit as well. So thank you for that. So any final words, Paul, before we close?
Yeah, it's been a fantastically good discussion, Tony. Thank you very much. I've really enjoyed this discussion. I historically and still am a little bit of a skeptic when it comes to stable coins and cryptocurrencies, etc. But I'm a technologist and I love change. I love the way things get disrupted and we see new opportunities in the future. So I love to be proven wrong here. At the moment, I am skeptical. I'm not quite sure where this is heading, but I look forward to an interesting future. And this discussion has educated me, definitely. So thank you.
Thank you.
With those words, we will close it for the first episode of this season of Fintech Daydreaming, which I believe is number 12. I can't believe it's been so long. But with that, the usual things we have to say in the end, which is, of course, like, subscribe, comment, leave us a review for magical, mystical reasons that actually helps people to find the podcast. We still don't know why, but it works. So anything is appreciated. Leave a 5-star review. If it's anything less, just send us an email, please. I think that's would be just fair. All right, good. That being said, we will see you in a couple of weeks again. And this has been Fintech Daydreaming.
This is Fintech Daydreaming.